Hello, everyone, and welcome to another episode of the Financial Advisors Want to Know podcast. I'm Catherine Tindall, one of the CPAs here at Dominion. We are a tax and accounting firm specially working for advisor practices to help them with their tax strategy and the different needs they have in their business. Today, I'm always excited to have another technical, compliance-heavy professional on the show. We're going to keep this really action-oriented for you from things we've seen in the field. And today I have with me Emil Ali. He's from McCabe Ali, LLP. He's a partner there, and he represents RIA advisors and broker-dealers in complying with SEC, state, and FINRA obligations. He also helps advisors break away from wirehouses and form their own advisory firms while ensuring that they stay compliant with the broker protocol, negotiation of promissory notes, and any FINRA arbitrations. So thank you so much for joining me today, Emil.
Thank you, Catherine. And I'm surprised that you say you're excited to kind of geek out with somebody like me, because you're in for a big surprise. So
I think tax and legal is just one of those things where you have to be kind of a weird person to really get into it in the first place. But then, once you find your tribe of fellow compliance nerds, it's makes for, I don't know, we're going to have a really fun year this year, I think, in terms of both of our fields. Like I saw the SEC leadership's getting changed over, and, with the new administration coming in, I think I'm anticipating there's going to be changes on that side. Like the whole tax legislation pieces are everything's going to be, kind of a toss up this year. So it's going to be a lot of, in terms of like an active year for us on the keeping up with changes. 25 is going to be a fun one.
Yeah. Looking forward to it.
So I think, like we were talking in the pre-show, most of the advisors listening here are running practices. They're trying to be more efficient. I think for a lot of them, a lot of the clients that we have in the firm, when we talk about compliance issues, not on the tax side, so just general compliance issues, it's something that's always just creating a level of anxiety for them in terms of, when they're growing and scaling these practices, they're always, it's kind of a boogeyman under the bed for them. So I'd love if we could start with, maybe things that you've been seeing in practices with some of these RAs that are maybe newer, don't have like a chief compliance officer maybe, or they're just still kind of going through the teenage years of professionalizing everything when it comes to the compliance. What are some things that you've noticed can be areas that maybe are red flags or pieces that advisors don't always pick up on in terms of areas where their attention needs to be that they might be missing out on?
Yeah, that's a really good question. So I guess first off, not having a CCO, that's kind of scary, because if you're an SEC registered investment advisory firm, you need to have a named CCO, and then state by state, it could differ whether you need one. But, I think the question that maybe if I can reframe it is, how do firms think of compliance? Think of, legal. And legal and compliance are slightly different, but there's quite a bit of overlap. And the way I like to think about it is, I wish that when you were starting a company, a firm, whether it's a CPA practice, advisory business, broker-dealer, I wish I didn't have to pay for that. I wish I could have the proof of concept and see how this works before worrying about compliance.
Yeah.
Unfortunately, that doesn't work.
Yeah.
We're in the advisory practice is kind of self-regulating to some extent. You have FINRA, you have the SEC, you have all these regulators, either governmental or non-governmental, quasi-governmental, and then you have yourselves. The SEC doesn't sit there and regulate you on a day-to-day basis. They expect you to have an internal regulatory structure. And because of that, you're expected to have all these great tools, whether it's, compliance manual, and then testing of those policies and things like that. So what I like to see is from the moment you start to, your successful, situation that you're in 2, 3, 4 years down the line, that you have all the tools that you need to succeed, whether that's a professional CCO, compliance consultant, or you take it upon yourself to train yourself or somebody else on your team to assist you with that. And I think that's, there's not a one size fits all approach. People can go and hire a professional CCO and pay them, $200,000 a year to sit there and, try to do everything. They may be successful, they may be unsuccessful, or they could go pay a compliance consultant, and they come in all spectrums. You can have, unfortunately, terrible compliance consultants, and then you can have some very good ones. And you can hire a lawyer. You don't have to hire a lawyer to do some of these, ongoing compliance things. But I think it's creating a culture of compliance is really important, and realizing that you have to build that foundation, and it's going to slowly increase both in the amount of work you have to do in that role, but also in kind of the reaction that what else has to be done. And it's somewhat correlated to AUM. And as people hit different marks, once you hit 500 million in AUM, that leads you to say, okay, I need to focus on these extra elements of compliance. Once you hit $1 billion, you tend to get examined somewhat more frequently, maybe more cybersecurity risks, things like that. So I like to say that, it is difficult to say we have to spend all this money on compliance and legal, but think of it as a step in a trajectory to get you to, that growth curve that you want to get to.
Yeah, absolutely. Because it's funny, I have the same conversation a lot of times on the tax side where it's, whether or not there's $1,000 on the return or $1 million on the return, you've walked yourself into a level of complexity that there's just a certain level of things that need to happen because you're now in a bigger infrastructure of complexity. But at the same time, it's, I think we probably have a similar experience. Like once you get between certain breakpoints within things, it's okay. Once you get from 1 million to 10 million, there's not a bunch of stuff that's going to change. Yeah. Or, like once we build those little, infrastructural pieces, like I'm thinking particularly like on the entity work side of things and like how things are going on the entity side. It's, we build those structures to be flexible, but then they tend to hold up to a certain size and then we have to retool them. And so that ends up being, a big part of it. In terms of like experiences you've had in actual practices, obviously without naming any names that would identify people, but are there specific stories that stick out to you in terms of places where you tend to see people get things wrong or, scenarios that kind of, backfired or didn't work that should be like a warning tale for those listening to this?
Yeah. So, a lot of people ask me, they say, do I need to be the CCO? Right. So you're creating an SEC investment advisory firm. Let's say you're going from a big wirehouse and you have $400 million book and it's going to be you. And let's say 2 or 3 other people, you're the only kind of registered person, real IAR. And let's say the other 2 are more assistants. And you say, do I need to be the CCO? I don't want to pay a third party. How can I set up the structure of the firm? And I'll say, you don't have to be the CCO. The CCO does not need to be an investment advisor representative, right? They're not a FinOp. We're not on the broker dealer side. We're thinking right now on the RIA side. So I'll say, well, maybe you can empower one of your assistants, non-registered folks, to hold that role. But here's the problem. They need to be empowered. They can't just have the role and say, oh, I'm not doing anything, because they could have their own liability. And by and large, I've seen many people that they put their lower level staff member, which again, there's nothing wrong with that, but they put them in charge. But then when that staff member is trying to do their newfound job of being the chief compliance officer, they're not empowered to make change. They're not empowered to effectuate change. So, for example, one of the basic things, which I know can be very annoying to many IARs, is email review. That's something the SEC expects that you do some sort of review of the communications inbound and outbound. It's a good way to make sure that no one is doing something improper. So let's say that assistant who's now CCO has to review her boss's email. Her boss says, no, I don't want to give you access to the email. That's, that creates a problem. So that's an example of something I see all the time, because, sometimes I may not find out about it because maybe they use some other company compliance consulting company to set up the firm. They're not asking the right questions. And all of a sudden during their exam, the SEC is asking the CCO, are you empowered to do your job? And the CCO is like, well, what do I say? You don't want to lie, right? And it's like, well, no, I'm not empowered because I'm not allowed to do anything. It's a CCO in name only. Yeah. And those are examples of where it can be really, really problematic.
Yeah, no, that's a really good example. And probably for people listening to this, we had previous episodes, I think, where I was talking about bringing on executive assistants to do your email monitoring. So maybe that's where you should be questioning it too. Of are your emails efficient if you're running the operation and you're the only one in that email inbox? But that's a really good point. And I think maybe another place that's I'd be interested to hear some of your stories around would be, for people who are, what you've seen when helping people break away from the wirehouses and when they're in those first couple of years forming the firms, like some of the challenges that you see them face.
Yeah. So I will say that the biggest challenge I see when somebody leaves a firm is not understanding that they don't have this structure in place, right?
Mm-hmm.
Whether it's Morgan Stanley, whether it's LPL, whether it's any of these other companies, maybe you're just working internally in Schwab. So you come to independence for a couple of reasons. Maybe you have a problem with the people that your management structure. That's one thing. The other place that you might be having problems with is financial. You might say, well, I want 100% of the pay, right?
Mm-hmm.
I don't want to pay an override. Great. But when you're paying that override, that structure, that you're the sharing of, fees, you're doing so because that company is taking on some risk, but they're also taking on some responsibilities, right?
Mm-hmm.
Being the CCO, having all these different roles is very, very important. So I guess my point is that when you have that structure in place and all of a sudden you lose it, you think that it's still getting done, but it isn't.
Yeah.
And the funniest joke about it would be if somebody wanted to write a blog or have a podcast and they worked at a larger firm, in any firm, technically, you have to get the consent of your CCO to do it because it's considered, marketing and something where under most compliance manuals, you have to get some sort of consent.
Mm-hmm.
So let's say I was at Morgan Stanley and I wanted to get consent to have a podcast. Maybe Morgan Stanley would say yes, maybe they'd say no, but whatever the case is, they'd ask me to write it up. And I'd say, I don't want to do that. Let me start my own firm.
Mm-hmm.
I start my own firm and I just go ahead and do the podcast. I didn't ask my CCO executive assistant, or I didn't, paper the file, and now I'm in trouble, right?
Yeah.
So, you think you're changing something to make it easier for everyone, but you're not.
Yeah.
Right? You're creating you're leaving a structured system for what should also be a structured system. Maybe it's going to be more beneficial because you're in charge. It's smaller organization, it's less bureaucratic, but you still need to have a structure in place to comply with the SEC's rules or any other rules that may be applicable.
Yeah, no, that's a really good point. And I've noticed that too with, some of because I've seen firms go through these transitions where they go independent and things change. And, for some of them where they have that really strong internal organizational ability, they've got some really, like a really good COO in place. It's easy for them to take on those it's easy for them to institutionalize and take on a lot of it. But I've seen with like some of the smaller operations where they go out on their own and then it just becomes, I didn't quite realize what I was getting myself into in terms of all the back office now that you have to take on internally and making it happen. Yeah, that can be spooky. In terms of, things that genuinely scare you, versus, maybe some things where they're more just, you're going to get dinged for this. This is incorrect. It's like, getting pulled over with a light out in the back of your car versus, getting pulled over with a bunch of drugs in the car. Of things that like genuinely scare you that you commonly see, are there scenarios that you come across a little more commonly than you would like to that, you think are, maybe more mission critical, dangerous for people when it comes to the compliance issues? Just a slight interruption in this conversation. I wanted to bring to your attention two things that are important for you to know. So we're always at the mercy of social media algorithms. So if you can subscribe to the show, that would mean a lot to me. Even more to me if you can leave a rating and let me know what you think about it. But we have a new newsletter that's coming out. It's going to be very active in 2025. That is specifically around tax issues that I'm seeing advisors face in their own practices, changes in legislations, and the pieces that I think are critically important for you to stay ahead of as an advisor with the new administration. So nearby, wherever you're interacting with this, will be the link of how to sign up for our newsletter. Also nearby will be the link to my LinkedIn, which is the best way to get in touch with me, learn more about what we're doing for advisors in the tax strategy and compliance work that we do, and also to get access to the various tools and interviews and things that I do, specifically designed to help you improve your practice, improve your own tax situation, et cetera. So let's get back to the episode, and thanks for tuning in.
Yeah. Well, let me tell you, every year is different. right?
Yeah.
I have had so many different stories that I don't even want to get into. It's like PTSD for me. This year was the story of my life was off-channel communications. Okay.
Ah.
So, which, by the way, speaking of new administration and Gensler, leaving the SEC
Yeah.
shortly, my kind of educated guess is that it's very likely that we are going to experience hopefully a better regulatory environment for advisors.
Yeah.
What does that mean? Advisors hopefully would have less enforcement actions and smoother investigations. We hope, right? That's my hypothesis right now. But what happened this year? We all probably text. We use our firm uses Teams. Many people use Slack. Many people use all these different methods of communicating. And I don't love texting with my clients. Why?
Yeah.
Because it doesn't always get into our system. Some of the phone numbers we use go to our system, but if you text me on my personal phone number, it doesn't end up in the client file unless I manually do.
Yep.
Why is that important? It's important as a lawyer for me in case somebody says, well, you didn't do this or you didn't tell me about this. It's nice to have everything in one smooth area. But why is it important for advisors? Not only for that reason, but also what if you start getting trading instructions? Or more importantly, when that CCO, and this is like a common theme of today's conversation, what if that CCO is trying to do a review? They're not going to see that text message.
Yeah.
And I have experienced so many cases right now, both at the SEC, but also having not gotten to the SEC yet, where some advisor, like representative, will send text messages to the client kind of off channel, not just because the client texted them, but more because they wanted to convince the client to do something that they knew they would get in trouble for if they had done so through regular means. And an example would be, hey, you should buy this private placement. And the client's like, I don't have the money for it. It's like, oh, well, why don't you take a HELOC on that? And, it might be against the terms of, your broker dealer or advisor to tell them to borrow funds to invest in an asset, because obviously it's very high risk. And it's like, okay, well, I'll just text message and do that. And then guess what? When that asset doesn't do well, that client hires an attorney who then sends a demand letter to the firm. And guess what they include? Copies of those text messages. That's not fun. That's not something I want to deal with. That's not something my clients want to deal with. So, I like, that's probably been one of the bane of my existences for this particular year, because so many advisors have not properly educated their team on not using it. And it's like, it's one thing for an owner or a CCO to say, hey, please try not to text message your clients. But the SEC has said that's not enough. SEC wants you to check. They want you to do certain search strings. They're not going to tell you what they are, but we've kind of developed things that we suggest that you do to help better understand whether or not somebody might be texting. Yes, ideally, it'd be nice if you could search everyone's phones. It might be allowed under your state's rules, but it may not be something you want to do. So there's other ways to go about doing that. But there's also things like provisioning the phone, making them use a work phone. But here's the added benefit. If you make them use a work phone, you may spend an extra $50 a month giving them a phone, and they might break their screen or, let their kid watch YouTube on it. But at the end of the day, the best part about it is the client does not have their personal phone number. So if that advisor leaves, now you have another way to keep those client lists confidential, keep the advisor's, contact information easily forwardable back to the firm itself. So there's some added benefits to it as well from kind of a client protection and management.
Yeah, no, that's a great point. And I know that there's a number of tools out now, because I think a lot of people make the argument of, I need to be able to text my clients. That's how they want to communicate with me. This is a generational difference. And there are a number of tools out there now where you're able to, as a business, deploy text messaging as a channel, but still be able to see it at a team level, to be able to monitor those things. Like, so for instance, we're going to be getting a new system, and to be able to do this with people, of being able to just text back and forth, but where it stays it's still on channel for us. So everybody on the team still has access to it, and it goes into the CRM where the rest of their stuff lives. So I think it's definitely worth, taking a step back from an operational level of, if you have junior advisors or people on the team that are doing these communications off channel, you are losing that information out of the CRM. You are losing that data. Like, just beyond the compliance issue, just from an operations perspective, it's like now it makes it so much harder to service those clients. Like, it just makes everything harder because you don't have the full context for those relationships of, say you've got somebody on a particular case, and they, have a family illness and they're out of the office for a couple of months. It's like, you don't know what the conversation looks like unless they've been off channel. You don't know what they've been saying. And it just looks bad to the client. So that's, just from a compliance standpoint, I can see why that's a huge issue. But then also just from a practical operations standpoint, it's, if you're going to need texting and you need to use that, finding a compliant system for you to still keep that on channel, which there are plenty of things out there, plenty of different tools for that. But that's a really good point. It's something that I think too, especially maybe for older firm owners who aren't used to that generational change too, of like a lot of the younger generations, like I encountered this probably more specifically with like boomer firm owners, are just like not used to the ways that maybe the younger generations are communicating. And so they wouldn't even expect to see like, I have an advisor who's trying to find business on Instagram. Like, I didn't even realize that they like had their own Instagram and was, like if you have somebody junior underneath you doing stuff, they might not be aware of some of those pieces, especially on the marketing side.
And it's a great point, right? It's not improper or against the SEC's rules to engage in that sort of marketing. I'm not going to say it's a good or bad idea. I have certain clients that'll say it's a terrible idea, and I have certain clients that are gung-ho on TikTok, Instagram, Facebook, whatever.
Yeah.
Each their own, great. But brings me back to the compliance piece. Make sure it's approved. Make sure the statements are correct, et cetera. But, speaking of kind of generational issues, the other thing that we've seen a lot of is, during COVID, the markets were very high, and, they're still high now, which means AUM numbers are greater, but multiples were greater for selling firms. Mm-hmm. And that we've seen a lot of roll-ups, but also just asset sales and selling of firms to other people. We have the younger generation coming in, so people are buying and selling membership interests or shares of advisory firms. And that's the other area that we kind of are thinking about, is like, is that a good idea? And, you and I have been talking about this. Is it always worth it to bring on partners? Is it worth it to sell a firm? Is it worth it to do all these things? And I think it's a multifold analysis. And, it's nice to talk to your CPA, talk to a lawyer, sometimes even a business consultant to think through these things. And I think one of the topics to think of is, one, do we have a business continuity plan? Right? Because firms are required to have that. What happens if I pass away, if I'm the sole owner? Is there going to be a leadership vacuum? But also, is my family going to get something out of this? Are there some assets and the short answer is probably there's a lot of assets in an advisory firm, and there's a requirement to make sure those, assets, not only of the clients, but of your own, of the firm itself, are taken care of. But the other thing that you and I were talking about is sometimes if you're a sole owner, you can have a trigger buy sell. That's good for business continuity. But what about now? How do we keep that next generation, enthused about staying with the firm? Because, I don't necessarily want to bring on a partner because, maybe I have to show them too much open kimono. But what about profit interest or revenue-based, AUM-based bonus structures, right? I think the next generation, like we've seen before, they don't care about fringe benefits. They don't care about their health insurance as much. They can go online and buy health insurance. They want money. And, a lot of structures, especially if you're in a state that doesn't allow non-competes or non-solicits, or, there's some limitations there. It's like, okay, well, how do we structure a comp plan that pays them for what they're doing, but pays them to continue to grow, and then maybe pays them out at a certain point only if they're there next year? So if they want their 2024, extra comp, they better be working in March of 2025. And, that's not just because cash flow, it's also because we want to make sure that they don't just leave right when they've completed that, that year. There's a lot of cool ways to do this, but, ultimately find out what works best for you and for your team.
Yeah, no, it's a really good point. And I had a case recently with an advisor practice who recently came to us where they had profit shares interest, and very minority profit shares interest to, some fairly key but pretty junior employees. And I was talking them through the situation. I was like, why didn't Why didn't you just do like a bonus plan?
Yeah.
Because now we're having to fiddle around with all these K1s, and now these employees are having to wait. And also, with their profit shares, it's kind of the way that it was structured is they're basically guaranteed these profit shares versus having really performance-based metrics of, okay, here are the actual KPI drivers of performance in your role of, what we're trying, because they had some administrative people on this too, not just, advisor level people, and really dialing into, well, what are the actual performance drivers here? And then can we just add this in as, bonus W-2 comp at the end of the year? And then it gives us the flexibility to change it on a year-to-year basis. Because like for this practice, they're growing they grew 40% last year. They're doing some acquisitions. They're going to probably try to double the practice within 3 to 5 years. Probably within 3 years, I think they'll be able to get it done. I think I have more faith in them than they have in themselves. They're gonna be able to get it done. And so it's like your practice is transforming like year over year. So the structure that you're building around like some of these profit interests where it's flowing through these K1s, you need something that allows for more flexibility, and doing something like a bonus program, can allow for that until you get to more like steady state where it's, okay, yeah, we have a real succession plan going here. These people have been with us for X number of years. Like they're not going anywhere. We have, this is the way that things are going to drive forward. And we have that level of trust, et cetera. Then awesome. Let's break into the equity and figure that out. That needs to happen. And, certainly before then, like the continuity planning is so essential. Like I was having this conversation earlier with an advisor where he had a family member pass away who was an advisor and didn't have a continuity plan in place. And basically what happened was within like a day or two of his passing, the broker dealer who he was with farmed out all the accounts to everybody else, and the widow got nothing.
Yeah.
It's just awful. So it's one of those things where, it's one of the first questions that I have with new clients that come into us is like, what's the continuity plan? Because you never know when you're going to get hit by that bus or, get that cancer scare or whatever it is. So getting those pieces in place, but in terms of that, longer trajectory of equity, it's, there's a number of games that you got to play with it. But so this was a fantastic conversation. Any closing thoughts that you have, Emil, of things maybe we didn't hit today that you think are, relevant for people to keep in mind as we're going to be having this come out in Q1 of 25, pieces that you think firms should be, keep on the horizon for them?
Yeah, so I definitely encourage advisory firms, big and small, to pay attention to the SEC exam priorities, especially if you're an SEC advisor. Those come out in the fall. And so we just had them come out earlier this year. Obviously, if this publishes in 2025, they'll be a little bit stale, partially because they were done before the administration change, but obviously things can change, but there's still a good guidance point to what the examiners are trained on. But unrelated to that conversation that we had today, I guess, people always ask me to talk on behalf of all lawyers or, people that work in the compliance space. So I'll give you one little point. When you're looking to talk to an advisor or a lawyer, let me just apologize in advance on behalf of them. I know we're difficult to talk to, but I encourage you, whether you're happy with the folks that you're using now, or that you're looking to start using somebody because you're starting a firm, interview multiple people. Right? That's just, you have to feel comfortable with the advice that you're getting. So whether it's a CPA, whether it's a lawyer, whether it's a compliance consultant, heck, whether it's a marketing person or, whatever you're using, definitely talk to people. Don't be completely price sensitive. Talk to people about their and just feel whether or not you can interact with them. It's a two-way street because I'm going to give advice, but the client doesn't always have to take the advice, right? That's what helps a lawyer, is that we have the protection of privilege, that just because I gave some advice doesn't mean the client has to take it. And that's confidential. No one's going to know about that unless the client tells other people. But what's more important too is to push back and say, no, this is what I want to do. How can I get there? And, my job is to give options on how to get there. Just like as a CPA, your job is to give people various options, and people forget about that. They're scared to talk to us. They're scared to have a conversation. They're like, I don't want to talk to Emil because I'm going to get a bill and he's going to tell me what not to do. It's like, that's not the conversation I want to have. So I want people to find lawyers and people that work in compliance and other professionals that we can have a two-way communication. and no one feels afraid to talk to us.
Yeah. No, it's very true. Because I think a lot of the conversations I have with advisors, specifically on certain issues that really overlap into the realm of their core competencies, the conversation is, this is how I think about this. This is, the frame that I use to make this decision. But here are a number of other frames that also apply that need to be referenced. And what's going to be like, this is how I would work through it if I were you. But maybe there's other pieces in your life that would make this be a little different, or, your attitude towards things. And I'll have two advisors where they're in the same situation and what works for them personally is different. And so being able to speak to both sides is really important. So for those of the advisors who are listening here, who are interested in getting into your world, what is the best way for them to get in touch with you, Emil?
Best place is to go to our website, which is McCabeAli.com, or to reach out to me on LinkedIn. You can just search my name, Emil Ali. So thanks again for the opportunity.
Yeah, I love it. So we'll post those links nearby, dear listener, wherever you are encountering this content. And I'm always interested to hear, as we're, approaching filling out our calendar for 2025 of podcast episodes, if you have specific technical issues or things that you are interested in us going into the weeds and deeper on with different experts like Emil, I'm always interested in getting your feedback and learning more about, what you took out of the episode and what you're interested in learning more about. But thanks again for coming on the show. I appreciate you being here.
Thank you.